Hi, it's Lee and welcome to the Tesla Economist. I recently made a video explaining that Tesla can still double profits even if they drop prices by perhaps 10 to 15% if they're able to double their production. I say production, not deliveries, as in this scenario, the prices have been lowered so the demand should be sufficient enough for them to sell every car they make. I'm not even suggesting that Tesla even need to drop prices, and probably not even likely to where the prices were before when Tesla started raising them. Like Tesla's Shanghai Model Y is still at a higher price now than it was last year, and Tesla have reduced the cost of production since then. Anyway, this actually made me very bullish. The fact that there is so much operating leverage and economies of scale still to come from this company, as production numbers are relatively low for a major auto manufacturer. Tesla just need to keep making enough cars. By the time we get to a production level of around 750,000 a quarter, I think we will see a big difference in operating margins. It all comes down to these two new factories. We're probably at around 450,000 a quarter from just Fremont and Shanghai by about the end of this year. So we'd still need another 300,000 a quarter to reach this level of 750,000. I think the main thing that is confusing people right now is that they don't realise how good margins still really are. They seem to think inflation has kicked in too much, demand is down, prices are being lowered, the dollar is adding to cost, and we're losing our once fantastic margins. Except last quarter, we still had 28% margin, and that was with a relatively low regulatory credit quarter too. Not only that, last quarter, Tesla had to pay for the line upgrades in Shanghai for 2 factories, and those costs went into cost of goods sold, which would have affected margins further along with that downtime. But people aren't interested in specifics. They just want to take the good with the bad and accept that we are losing here and capitulate and cope with their losses. But a 28% margin still isn't that bad. And yes, I understand this was with the old Shanghai prices, but those price changes affect overall margins at less than 0.5%. I might even work that out sometime. Although the ramp up could have possibly reduced costs enough to match the price drops anyway. However, the main drag on the margins were the new massive factories. Profit margins there may still be low. They're huge facilities, with capacities that we really can only speculate on. But 1 million Model Ys is surely believable, and we hear that's pretty much possible just from the Shanghai Model Y factory. So they really are hurting margins the most. Anyway, we need 300,000 additional units a quarter, which is quite a lot still required. I can't see that happening until late next year if things go reasonably well. So perhaps we'll look at this differently, as right now I think people want to know when a shorter term recovery might occur. When the stock price might be back to about $250 or so. Wow, who would have thought would be happy to see Tesla trading at $250? What we need is for the new factories to stop killing margins then. I would say that once we are at volume production with these factories, at around 65,000 each per quarter, then we should see margins back up. But let's say 150,000 combined, taking a total quarterly run rate to 600,000. Now, Elon says that Berlin will be at this rate early next year, and the way Texas is going, it might be at the end of Q1. So how about, for argument's sake, we say that for Q2, Tesla are able to produce 600,000 units. Bear in mind, Elon said at the end of this year, they're at 525,000 a quarter run rate. So we're only talking about a 12.5% increase in production by then. I don't think that's too extreme. At volume production, I would say there is a high probability that these new factories are around a margin of 30%, quite possibly higher, but 30% will make a huge difference. But no one's in the mood for hope right now, so I'll just keep it easy for you to believe and give all the factories an overall margin of 30%, including regulatory credits. Then if we use an ASP the same as last quarter, even though the dollar has weakened a bit since then, and the ramping up would all be from new Model Ys that do have a higher ASP, we'll use what is likely the lower ASP again, keeping this easy to believe. Then let's run some quick numbers. Well, this means that revenue becomes $32 billion, up from $17 billion in Q3. That's not far off double, because we have almost twice as many deliveries, 600,000 compared to 343,000, which isn't really telling us much as we use the same ASPs. But now we're talking about a 30% margin instead of 27.9. All right, now it gets a bit more exciting. We've nearly double gross profit, 5.2 billion compared to 9.8 billion. We're excluding tax credits and subsidies here, keeping it easy to believe with as few hopes and dreams as possible. We will add in the other sides of the business too. Last quarter, Tesla profited $170 million. I would hope that would be approaching close to $1 billion by this time, with the energy business coming into effect. But let's just say $300 million. Now the OPEX. Now this is what I'm trying to refer to from the previous video. This is what makes a difference. This is where it gets really exciting, people. At least I hope, or else I've just built up your hopes. We will raise OPEX 20% from Q3 and subtract that from our total gross profit, giving us slightly over $8 billion in operating profit for a 600,000 delivery quarter, compared to $3.7 billion before. Operating profits up 118% from last quarter, yet deliveries only increased 74%. Deliveries up 74%, profits up 118%. This is due to two things: margins increasing slightly and OPEX per vehicle reducing. Yes, tax does come into play now, and Tesla will have a higher rate of tax with higher earnings as the depreciation becomes relatively less. I think the gross margin should really be closer to 32% though, if Tesla are at this level of production. I also think the ASPs will be higher due to the cars that Tesla are ramping have a higher price. They also have a higher margin. Then we have subsidies and tax credits on top of this. But I tried to keep this believable, so it's up to you when you think Tesla can increase their rate of production by about 12.5%. This is basically the financial situation we might expect. After tax, it's probably about $6.9 billion, or around $28 billion annualized, which is currently 1/18th of the market cap. So ask yourself, when you think Tesla can hit this run rate, or just over volume production for the new factories. My guess is sometime in Q2. Personally, I think the stock should be a lot higher once this is achieved. I don't think macros will be punishing Tesla to this degree, unless the economy has got dramatically worse. But look, I don't want to tell you that this is going to make the stock shoot back up to $400 or something, but I think this might be that lifeline that can take us back to a more tolerable $250. It would mean that Tesla would be trading at 28 times the annualized earnings of this run rate. Also, it's likely that Elon has calmed down on Twitter by then, and it's no longer hurting Tesla's stock price, and it's starting to recover from that. If the economy is really that bad that the stock is still sub 200, then the market is being seriously punished. I hope that's not the case, but it's very unpredictable. If we need about 150,000 Model Ys from the new factories, and if it's only 4680 sales and no 2170 sales or LFP sales, then we need 10 gigawatt hours a quarter run rate to achieve that, or a 40 gigawatt hour annual run rate. But this isn't for probably another 6 to 7 months. And at this stage, it does look possible. It might also show more confidence in the market that Tesla can produce 4680 cells, albeit a lot slower than we were told. Yes, there's plenty of exciting Tesla events to come, but the market really doesn't care anymore. Hey, a lot of you don't even care anymore. You just want to recover your losses. You plan this future in your head. You hope to buy a larger house, travel the world, buy a business, invest in some property, help some people in need, subsidize your child out with their first house, or buy a Tesla. Your reality has changed, and you're adjusting to your new future. The exciting one seems much harder to believe right now, but I don't think these numbers are too far-fetched. And even if it doesn't happen until Q3, a $250 stock price is still a lot more easy to cope with than $170. It's always much harder to believe the magic in the down market. But it's going to be numbers that will move the stock. Solid, tangible numbers like these. Even if Elon announced FSD is now safer than a human, the stock is not going to budge much. Even if he said by an order of magnitude, it's too much like the boy who cried wolf. He's lost his credibility when it comes to FSD timelines, unfortunately. You have to judge for yourself. But as you know, I focus more on batteries, as that is the tangible side of the growth of the business. I've learned as much as I can about batteries and cells and the entire production process. Q4 should hopefully be a lot better than everyone is expecting to, but at this stage, I feel it's even going to struggle to hit $200, even with 450,000 deliveries. After Tesla hits 40 gigawatt hour a year run rate for 4680, then all the ramping that we will see from there will be highly profitable and will start to move the stock again. We just need to wait for the financials to catch up. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.